Hi, good afternoon, good evening, and welcome to our lecture 3 of Audit and Attestation. We will be continuing with our chapter Engagement Responsibilities, and the next part of the chapter is defining our professional responsibilities. So, what are the professional responsibilities that are imposed on an auditor? Your responsibility, as in, what are the things which are unconditional that an auditor has to follow? What is something which is presumptively mandatory, and what is something which they should consider? Coming on to our first one, what is unconditional? Unconditional will be anything that you read which will have the word must in it. The auditor must do this. You must study if you want to clear the exam, correct? So what can be something like a must? An auditor must be independent. What does that mean? That if an auditor is not independent, you are not qualified to do an audit. If you do, you will probably be against the rules, and you will be open to a fine, or you could also be open to having a lawsuit against you, correct? So this is something which is must. You must be independent. You must not disclose any confidential information. See how it goes is that you need to be authorized by the company to disclose certain information to certain public. If it is beyond that, if it is anyone beyond that, you cannot tell them stuff. You cannot go and tell your friend that, hey, you know what, buy this stock, it will go up. It is against the law, it is against the rules. You cannot disclose certain information, correct? You cannot, you must not, that is the word. If it is written must, you must not disclose, you must be independent. These form a part of your unconditional professional responsibilities. Your second part is presumptively mandatory. Presumptively mandatory is something like should. When I say should, it means that you should obtain, let's say, an engagement letter. So, what's an engagement letter? An engagement letter is basically your agreement. I will be auditing your company. Okay. What is the proof of this conversation that happened? What is the proof of this fact that I will audit and you will pay me? That is an engagement letter. You should obtain an engagement letter. Why? If there are disputes, what is to be followed, what is the amount of payment that needs to be done, everything will be written in that engagement letter. So before starting an audit, one of the prerequisites is that you need to obtain an engagement letter. You need to write things in it. For example, if the auditor does not do their duties, what will happen? If the management does not provide their documents, the documents that we ask, what will happen? What things will be covered in the audit? What extra costs will be borne? If yes, by who will it be borne? So all these things should be written in your engagement letter. Correct. What other example can we have? Let's say a gift or an acceptance of an gift. So you should not accept gift from your client. If I'm an auditor, my company and the company comes and tells me that, hey, can you give me a clean report? That is, can you give me a unqualified report? And in exchange, I will, let's say, just gift you an expensive watch, or an expensive, if I have, or I have an expensive bag for your wife. Anything, like, you are doing it in cash, or you're doing it as a gift or something. So all this is, it's not allowed, right? Because by this they are trying to impair your judgment. You are no longer independent. So you should not accept gifts. But why is it not must not, and why is it should not? Because something, let's say, if it's a token of appreciation, like a small diary or a small pen, or just, some, let's say, a chocolate for because it was your birthday or something, anything as a small chotusa, which is immaterial, which is insignificant, those kinds of gifts you can probably accept, because this will form a part of your goodwill, that you are building a rapport with your clients, so that in the future you will have more business heading towards you from them. So this is just something which is sort of, as a friendship sort of a thing. Again, it should not go over and above, because then that will form a threat, a familiarity threat for you. So You need to know where to draw the line. As a professional, as an auditor, you are expected to know that line, so that you know by at what point you are a professional versus at what point are you becoming personal. So that is your presumptively mandatory. And your third is your should consider. Should consider does not have any such word attached to it. Should consider is pretty much dependent on the professional judgment of the auditor. What do you mean by the professional judgment of the auditor? They can take a call. The audit, as a body, we think that auditor is, you know, sensible enough to take a judgment. Judgment on what? Let's take an example. A self-interest threat. So what happens is that okay, you've been with them for a long time, giving gifts, small gifts now, but it's been 5 7 years, very close. So now, whether should I continue the audit or not, that is something which will form a part of my professional judgment. Correct? I should consider, as an auditor, I should consider whether I am using my professional judgment to check if I have a self interest threat. Let's say if I do, I need to take steps accordingly, that is, either withdraw from the engagement or maybe take steps to make sure that it does not happen. Whatever the steps will be, whatever we'll discuss in the future, that will happen. But the point is that, or let's say if I'm sure, if my judgment says that no, there is no familiarity threat, there is no self-interest threat, then it's fine, then you can continue with the engagement. Fair? Make sense? Cool. Okay, coming next to our audit report. So what happens in an audit report? What is an audit report? It's like your final concluding statement to your entire audit, that we did these procedures. As an auditor, I will make this, that we did these procedures on this company, and this is a final judgment. So in that case, your auditor judgment, we've already covered this in the previous lecture. What are the 4 kinds of judgment? We just do a quick revision. You have 1, unmodified, which is also your unqualified. It's the same thing. Which means everything is correct. Great financials, great everything, no issues, we're fine with everything. It is as per what is presented in the books, is showing the actual figure. Correct? Next is your qualified opinion. That is, except this particular part, everything is right. Except this inventory figure, everything is right. Except this depreciation part, everything is right. That is your qualified opinion. Of course, it could be except a list of 2 or 3 things, not necessarily just one thing, but yeah, except this particular thing, everything is right. Okay. Third, adverse. Pretty much everything is wrong. Like 70% of the stuff is wrong. 70%. Okay. It could also be that only a few things are wrong, but they are so wrong that it affects everything else. So that way, then that would be an adverse opinion. And your fourth is a disclaimer of opinion. Disclaimer means that we do not have enough data to comment on it. Okay, so we have already covered this. We did a quick revision. This is the same thing, unmodified / unqualified. Now we'll come to this plotting in this table. Let's understand what's on the x-axis and the y-axis for the table first. Auditor's judgment. What is an auditor's judgment? These are the auditor's judgment they are supposed to give in the audit report. Fair? Now, M and P, material and pervasive. These are the 2 words that we need to discuss. And here we have financials being materially misstated and inability to obtain SAAE. What is SAAE? Sufficient and appropriate audit evidence. This also we have covered. Just a quick revision. Sufficient means your quantity and sufficient and appropriate. Appropriate is your quality, correct? That the audit evidence, that is everything that you've obtained to check the numbers in the financials. Are they sufficient? Are they appropriate? Have you, so inability to obtain, it means you have not been able to obtain either sufficient evidence or you obtained evidence, but it is not appropriate, or both, correct? So one case is if you have not received information. Your second case is if your financials are materially misstated. What is material? What is pervasive? In layman language, material means something that is affecting, that is, ki if it's, let's say, if the revenue is of let's say $1 million, then for that something like 500,000 would be material, but something like just 1,000 would not be. Versus what is pervasive, that everything is affected. Let's become a little more technical on these terms to give you a better idea. Material says that it is significant enough that if it was different, then it would have affected the economic decision of the users of the financial statement. What does that mean? That if let's say my revenue stated in the example, like we have this $100 million revenue, materiality would be something like $10 million. That if instead of 100 millions it was $110 million, it was inflated, I wouldn't have probably cared that much. That it's fine, 110 being 110 reported, it's not a big deal. Versus if it was, let's say, 100 million was the actual, but they reported 200 million, then would my decision be affected? Of course, it would be affected. I would think that with so much expenses, with so much capital, they are making so much revenue. I would be impressed. I would probably invest in the company. This shows that this is a material figure, correct? So this means that anything that is significant enough to affect the user's economic decision making power. So if my, just this, think of it this way, if this number was different and if this number was instead of X, say Y, would my decision would have changed? If yes, then it's material. If it's no, then it's fine. Correct? Pervasive. Pervasive is defined that it is that significant that it affects all the parts of the financial statement. What could an example for that be? Let's say you are a parent company, you have 3 subsidiaries under you. You are, let's say, A Co, you have X, Y, and Z Co under you. This is profit making, this is profit making, but this is loss making. So when you were preparing a consolidated level financial statements, consolidated as an A Co plus X Co plus Y Co plus Z Co, and overall financial statements, you included A, you included X, you included Y, but you excluded Z. Because your figures would fall down, your profit would go down. So you did not include it, you just presented all this. Or you did something like you included the revenue figure of Z but did not include or you rather excluded the expenses part of Z. You did all those stuff, okay? Which means that ACO's financials are misstated, they are pervasively misstated. Why? Because it is affecting a lot of part of the financials. Your revenue, if let's say everything is not included, your revenue is less, your expenses are less, everything is less. Versus if revenue is reported, expenses are not reported, all your expenses are showing as less, your profit is coming as more. So that is pervasively wrong. I mean, a lot of things are wrong at an overall level, not just one particular thing. So I cannot write, that except this, everything is right. It won't make sense, right? Which is why this is pervasive. So now, if these terms are clear, let's go to this table. Let's do the first block first. So what we are saying is it material? Yes. Is it pervasive? No. So does it mean that your financials are misstated? Yes. So what opinion we will give you? We will give a qualified opinion. Let's take an example. Let's say your inventory is overstated by, for example, $100 million. $100,000. What will that affect? If your inventory is overstated, your first effect would be that your assets will be higher than usual. Second, your profit will be higher than usual. Why? Because how is your profit calculated? Your revenue minus the cost of goods sold. COGS. What is the cost of goods source? The formula for COGS? That will be your opening inventory plus additions minus sale minus closing inventory. You must have heard of this. So in this case, if your minus closing inventory figure is high, then your cost of goods sold goes down. If your cost goes down, your profit goes up. If this makes sense, then it means inventory overstating will have two effects. Two effects is something which is material, correct, but it's not pervasive because everything else is right. Except this one thing, everything else is right, and hence we are giving a qualified opinion. Versus if it is material, yes, it is pervasive, yes, it means your financials are materially misstated, yes, then you will give an adverse opinion. Why an adverse opinion? Because probably YCO is not included. If you're your ZCO, the loss making entity is not included. If it's that not included, a lot of things are going wrong, right? And hence adverse opinion. Your last two boxes. Material, yes. Pervasive, no. But you have not been able to obtain sufficient and appropriate audit evidence. In these cases, you will still give a qualified opinion. Because even though you don't have sufficient and appropriate evidence, you are sure that it is not pervasive. That is, you know that, for example, ZCO's figures are incorporated, but ZCO's figures are very small. So even though if there's something wrong in it, it is fine. So in those cases, even though you have not been able to obtain sufficient evidence, you know it's not pervasive, that it will not be enough to affect a lot of things. 1-2 parts are affected, it's fine. Hence, you'll give a qualified opinion that except this, everything else is fine. The last is material, yes, pervasive, yes, but you have been unable to obtain sufficient and appropriate evidence. So you know that we don't have the data and we know that it is going to be pervasive, it is going to affect everything. Then in that case, you give a disclaimer of opinion that we have not been able to receive enough information to form an opinion. Quick revision: material, yes; pervasive, no; qualified. Shortcut: if it is material and not pervasive, it is qualified no matter what. No matter inability to obtain or materially misstated, whatever the case will be. If you know material, yes; pervasive, no. Just blindly you can think qualified. If it is pervasive, then you need to think. If it is pervasive and you were not able to obtain, then disclaimer. If it is pervasive and you have all the information, then adverse. Clear? So our next part of the chapter is preparation. Preparation of what? Preparation of our financial statements. Now, this part is not from the point of view of an auditor, but from the point of view of an accountant. Like you are just an accountant who is there to help the company make their financials, pass their journal entries, make their ledgers, make their trial balance, make their P&L balance sheet and everything. So just an accountant here. So in this case, this is called a non-attest service. Non-attest means no opinion is given, no assurance is given. What was audit? You give an opinion or you give an assurance, you give a qualified opinion, you give an unqualified opinion, you give a disclaimer of opinion, you give an adverse opinion, you give an assurance if it is unqualified that the financials are giving a true and fair view, correct? But if in case of preparation, if you're just an accountant, you do not need to give an opinion or an assurance. You just need to make the financials for them. So in this case, you don't even need to be independent. I could do this for for let's say my relative's company. If they're running a company, I can make their accounts. Whatever actions are happening in the company, if they're making a sale, if they're incurring an expense, if they're buying an asset, everything I will just record. I do not need to be independent. Do I need to verify the accuracy? I don't need to verify the accuracy. If the company is telling me this transaction has happened, I'll be like, okay, I'll just record the same. Do I need to obtain evidence? What evidence are we talking about? Sufficient and appropriate evidence. What was this? This was from an auditor's perspective, whether the evidence for what, whether the accounts are accurate, or if they have their quantity and quality of the evidence that the transaction has really happened is true or not. All those things. Do I need to do that? No. Do I need to report? Report on what? Report on financial statements? I don't need to report. Am I giving an opinion? I'm not giving an opinion. I'm not giving an assurance. So I don't need to do any of those things. Correct? Similarly, am I required to identify or am I required to disclose any misstatement? Misstated could be what? A mistake or a fraud. Anything, intentional or unintentional. If I know it's happening, or if anyone in the company is doing it, I am not supposed to identify, or I'm not supposed to disclose anything. It's not my responsibility. My only responsibility is to pass the financials, pass the entries, and via which make my balance sheet or make my P&L statement or my cash flow statement, correct? Any wrongdoing, any non-compliance to what? To laws, to regulations, wrongdoings as in what? Any fraud. I am not supposed to identify, disclose, do anything. Just a normal accountant. What I will be doing, I will probably have a software which helps me record transactions as and when my client, my company will ask me that they want their balance sheet, they want their P&L. I will use this software to extract the same and I will share it with them. That is it. This is pretty much an accountant's job description. Now, there is just two more things. With these same features, you can do two other activities besides just preparation of your current financial statements, which is one, preparation of historical financial information, and two, preparation of prospective financial information. What does this mean? First of all, it is financial information, not financial statement. Financial statement is your balance sheet, P&L, cash flow, notes to accounts. Financial information could be anything. It could just be a part of my P&L, that is just my revenue, or it could be something like the number of employees, the record of the number of employees in the organization, or something like what is my future projection for any particular, or let's say the expenses or something. Just even one small part of it will also count in financial information, and something like the entire financial statements is also a part of the financial information. It's like a broad umbrella term. So I can prepare historical financial information. For example, there is some investor to whom we want to pitch. So I could just ask my accountant to prepare summary sorts of the past 10-year, performance of the company. Or I could ask them that, what is the market profitability going on versus our profitability. So that could be one sort of an historical financial information. The other one is a prospective financial information, that you prepare a forecast, that what am I expecting it to be 2 years down the line, 3 years down the line, 5 years down the line. If I'm a loss making company, what is the prospective period, that is in the when will I break even? Break even, that is I won't have a profit, I won't have a loss, I will be net. So by what period will I reach that break even point? All that thing is preparation of prospective financial information. For all of this, I don't need to be independent. I don't need to be independent. I don't need to verify. I don't need to obtain evidence. I don't need to do anything. Whatever data I am getting, whatever it is, I don't need to verify accuracy. I just need to make it. So preparation of accounts and historical financial information and prospective financial information. Usually I will just prepare it via my software, but this is specific to your current accounts that you are preparing, not for this. This might require different workings or whatever, however the case specific it will be. Coming to compilation and review. We are done with preparation. So there are three: preparation, compilation, review. Again, preparation, just an accountant's perspective. Compilation is something similar where you are technically assisting the management not giving opinion. Let's understand the points and then let's understand how is it different from preparation. Okay, so in compilation you are again assisting the management in preparation of their P&L, balance sheet and everything, and you are explicitly stating that I am not going to give a report, I am not going to give an opinion. So do you need to be independent? Yes, you need to be independent. You need to determine whether you are independent, and similarly you're supposed to disclose if there is lack of independence. Otherwise it's fine. You don't need to explicitly say I'm independent, but if you're not, you need to disclose it. Are you supposed to report on the FS? Yes. But what are you going to report? That I am not going to give an opinion. So you are not saying that it's a true and fair view, but you will state that where in the report. And will your name be associated? Yes, your name as CPA whatever will be associated to the compilation. Why do we do this? This is very similar to your preparation of financials, but these financials will usually be used further. Someone will rely on it at some sense. They are not audited, so it's fine. But there are things like, okay, I need a loan. For your loan, the bank will ask that, they'll ask you for your financials and they'll ask you for the last 1 month financials or last 3 months financials, which cannot be audited immediately. Hence, they will ask you for these, for financials in which a CPA's name is associated. So in cases like these, they need to be independent and, you need to report on them, and even though it does not have an opinion. Making sense? Next is review. Review gives you a limited assurance. Limited assurance also is referred to as negative assurance. Why? So we'll understand in a few minutes. In this case, do you need to be independent? Yes. What is a review? Review is, let's say your financial statements have been prepared, they're audited on an annual basis. However, if you are, let's say, a listed company, you cannot wait until 1 year to tell your investors how you're performing. So in those cases, you will release something known as your quarterly financial statements. Now, in those quarterly financial statements, what you do is that you get a review done instead of a complete audit, because a complete audit will take a lot of time and efforts. Hence, a review is done. In a review, you give a limited assurance, and it is worded in this sense that, see, usually how we say that everything, it is a true and fair view, everything is in order, correct? Here what you will say that we did not find anything which will tell us that it is not giving a true and fair view. It's negatively worded, there are negations, we did not find anything. So in that case, your limited assurance is a negative assurance. So we are not saying everything is right. We are just saying that whatever we have reviewed till now, we don't think anything is incorrect in that. Hence, limited review. So you still need to be independent. and you don't get your SAE here. You don't need your sufficient audit and appropriate audit evidence. You will just do an inquiry, that is like a Q&A thing. You'll give them a Q&A, they'll fill it for you, or it will be done verbally with the top management, and you will apply analytical procedures. What is something like an analytical procedure? Let's say you are paying rent for the factory. This month you paid, let's say, $10,000 rent. Next month you paid 10,500. Next month you paid 11,000. Seems okay, in line. Suddenly 1 month you are paying 18,000. Why? That you will inquire. Did you get a new factory? Did you change your location? Something. If not, if everything's in order, then what is the cause of that spike? So something which is actually unusual, which catches your eye, those things will come in analytical procedures. So these two perform majorly. You will just do this and you will give a review. Correct. Now there's one more point which we need to discuss. In compilation, this can be done for both historical and prospective, whereas your review can only be done for historical. Why so? Review is what? It's like an audit. It's not a full-fledged audit, but a short form of it. So that can only be done on historical. On prospective information, can you say that I got evidence that this is going to happen? No, there is no evidence. You are just using your assumptions, or you're just using your future contracts that might or might not happen. So in those cases, you can never give an assurance. You can never give a review on the prospective stuff. You can only provide that for historical information. Whereas for compilation, if I have made let's say my next year's plan or a next few years forecast, then all those or those prospective information you can still compile and have a CPA's name associated to it. Fair?